Hello, everybody. In today's video, I'm going to talk about stock clustering specifically, and then price dislocations. So stock price dislocations. A dislocation is more of a major move in the price from what the trend has been, and it gets reoriented into a very different price. Usually, a big move down if there's a big drop in the market. It could be a big move up. But it's also kind of just generally the movement of prices over time. So it doesn't have to be a wild swing. It can be more of a consistent or persistent pattern over time. So I'm looking at a list of ticker symbols. We have Amgen. These are all the components of the Dow 30. Apple, B of A, I think it's Bank of America. This is Caterpillar, Cisco, Goldman Sachs, Home Depot, Honeywell. I don't know every single one. I know most of these guys though. So this is going to be the input. We're going to get the data from Yahoo Finance, which I believe buys it from CapIQ. CapIQ captures all the prices. At the end of the day, I think they even capture it during the day, although I don't know if they only offer day end prices. I used to work there a long time ago, and back then it was day only. This might have changed. So it's coming from CapIQ. Yahoo Finance picks it up, and we get it after it's been cleaned up. If there's any problems with the data, it's cleaned up and loaded into Yahoo Finance, and we are dynamically choosing the start date as the current date and the end date as 1 month in arrears, so 1 month backward. So we're just getting 1 month of data here. Now you can hard code these dates, of course. I like to make it relative. I think for this exercise, 1 month is good. This date selection process is somewhat arbitrary, to tell you the truth. It could be 1, 2, 3 months. I think for our purposes, what we're doing here, I think 1 month makes sense. 3 is another common way to do this. I'll have another video where I'm doing portfolio optimization, and for that, I think 3 months is more appropriate. You want to see more history for those stock prices over time, but not too much history. But in this case, we're just looking at clustering, so we'll save that for another video. So I have the list of tickers. I'm going to loop through the list and go ahead and import each one, and then take a quick visual look at the head and the tail of the data frame, just for a quick sanity check to make sure everything's working okay. So I will post this code when I post the video, and you'll have access to all this stuff. So you can just copy paste it and run it, and everything's gonna work exactly the same. I'm using a Jupyter notebook. I'll show you why in just a bit. I like these notebooks because they have the ability to plot and chart dynamically. All kinds of different charts that you can interact with. It's very nice. It's quite a bit more interesting, or quite a bit more useful, I think, than the Spider IDE. I've used Spider a lot in the past, but whenever you're making dynamic plots and charts, you can't use that. So I think this is a great substitute for Spider. So okay, I've got the historical prices. Let me go down here. It looks relatively good. Okay, we're going back 1 month relative to today, and everything looks like it's on the up and up. So I think we can move forward here. I will run this code dynamically as I go, just so you can see that everything works as expected to, and that I didn't just who knows what, just throw together some garbage and then paste the chart in here. I don't know, but you can see everything is running in real time dynamically. So here's a correlation plot. This shows the correlations of all the historical prices relative to each other, right? So this comes basically from this correlation table. This is the function table.core, and the table again comes from this table over here. This is the table that we've pivoted. Originally, the data goes to a data frame. We pivot the data frame right here, dropping any duplicates. There shouldn't be any, but just to make sure, we couldn't do the pivot if we did have a duplicate. That wouldn't work. So just to make sure everything is fine over here. You'll see on the diagonal, you always have 1.0 correlation because that's the stock correlated to itself. But then you'll see the correlation with other stocks. So Apple and Amgen have 0 correlation. That's interesting. When Apple moves up, Amgen is going to move up or down or sideways. There's no correlation whatsoever. APX has a 0.4 correlation. BA has 0.6 relative to Apple. So if you wanted a More diversified portfolio, you would pick something with a low correlation or a negative correlation. Like you wouldn't put Apple and Disney together in your portfolio. You would pick one or the other because these two have high correlations, and Microsoft too. So that should make sense, right? Intuitively, I think Microsoft and Apple will move pretty much in concert with each other. And if they don't, you're going to have some kind of dislocation. And that's what we're going to analyze in just a bit. Like what clusters these stocks go into, we expect Microsoft and Apple to be together. If one moves out of the cluster, they're going to become reoriented. So if Microsoft moves, Apple's going to follow, or vice versa, or it's going to move back, right? Like that would be the expectation. And we put together a trading strategy at the end just to demonstrate that. So here's the first clustering experiment where you are doing hierarchical clustering. So let me run the code. Chart appears as it's being refreshed and built. Okay, so here's the clusters. You can see on the left you have Procter & Gamble, McDonald's, Triple M, Johnson & Johnson, Coca-Cola, IBM, and United Healthcare in one cluster. Okay, that's interesting. So these should move together. And if one of these moves out of the cluster, then we would expect it to, there's going to be a temporary price dislocation that's going to move back into that cluster. So that could be an opportunity to make some money buying shares of whatever ticker moves out of that cluster. And by the way, guys, this is not investment advice, so don't get angry if you try the strategy and you lose money. Don't try to sue me or whatever. That's not going to happen. But I'm just showing you the mechanics of how this works, and you can determine for yourself if it's worth it. This is a very interesting trading strategy, and compared to what a lot of people do, which is actually a lot of people have no strategy whatsoever. They don't really understand the stock market. So this helps fundamentally just helps you to understand what's going on statistically, mechanically, fundamentally, so you can make some very informed decisions about where to invest your money, how to make investments, the riskiness of your investments, so on and so forth. So here's the first part of starting to do the clustering. We have to create what's called an elbow curve. You can create a silhouette curve or an elbow curve. Both have different, slightly different applications and different uses. I think the elbow curve is probably a little bit more common to use this. So we're plotting out between 2 and 20, we're doing 20 iterations. For K in range, we're doing a loop of 20, I'm sorry, not 20, 20 minus 2, because they start with 2. So 18 iterations of where this curve is going to bend most, and where it's bending the most, that's called the elbow. I'm saying it's right about 5. I think 5 is good. So I'm going to use 5 as the appropriate number of clusters for the stocks. Again, we have the Dow 30. If we had 1, that would make no sense, really, because everything just dumped into one bucket or one cluster. But we don't need 20 clusters either, because it's going to be too scattered around. We want to create clusters that have stocks that are performing similar together. Those are going to be more homogeneous, and the stocks that are more heterogeneous are going to go into their own cluster, but those will be homogeneous among those stocks in that cluster. So here's everything printed out. Here's the curve, and let me print this. So here's the clusters. We'll have that in just a second. Name returns is not defined. Okay, hang on a second. Why is it returns? Oh, I think I didn't do the prior step. Okay. Okay. You have to do this in order, right? Otherwise you encounter problems. Okay, here's our clusters over here. So what's next? Yes, we're starting to do the clustering. So here's the K-means clustering. Okay, I've got the number of 5. That's my decided number of clusters to go with, and I'm going to use a Plotly Go chart. I like these Plotly charts because you can interact with them. There's the 5 right there for the number of clusters. You can interact with them, zoom in and zoom out, and it's a little more fun, and it's a little bit more intuitive, I think, than using just a static chart over here. So you can see this one's all by itself. INTC is in cluster 2. These are all in cluster 1. These are somewhat similar, right? They all get to the same cluster 3, and you can see on the chart, this is intuitive, it makes sense. These are all going to cluster number 4, and then Triple M is in cluster 0. This is always 0 based, so you always start with a 0 and then go up to the maximum number. I think it was 4, right? We don't see anything above 4, but cluster 4 is really the 5th one, right? It's just starting with 0, so it's always like n minus 1. So That's very interesting. I think the exercise worked out just like I would expect it to. Here I'm starting to clean up the data a little bit. If there's any nans, I'm going to drop that. And I'm looking for returns and volatility of returns so I can see how these stocks are performing over time. It's not just the stock price, but we have to see, is the investment performing well? What's the overall return? Is it positive, negative? What's the volatility? Is it high volatility or low volatility? Like the ideal scenario would be high return, low volatility. You don't want high volatility and low return because your stock price is going to be bouncing all over the place if you get that combination, and you're not going to be making a lot of money. So ideally, you're looking for high return, low vol. Okay, that's what we're getting down here. One more attempt to plot these volatilities and returns dynamically over here, and we can see what this looks like. And this actually is an animated chart. So when I click this button, we can see how these stocks are changing into different clusters over time, right? So if I mouse over it, we can see Coca-Cola, Verizon, I just saw that. Here's JP Morgan, and then the cluster that's associated with. So I think that is an interesting exercise too. Then we can start to track cluster transitions and start to look at these price dislocations, right? So here we are saying, here's the date ticker cluster, the previous cluster, and was there a change or not? So this is actually formatted as a float, and this is integer. Doesn't really matter in this case, so later we'll have to clean that up. Yeah, see, here's the float and the int 32. But you can say that these are cluster change. Yeah, it just changed from 4 to 1. This changed from 1 to 4. And this one did not change. This was 1 and it stayed 1. Okay, so that's going to be interesting too, to understand these location. And then the number of counts. So how many times did it change into clusters? Whoops. Okay, so I have to do every single step in between here. That's what you get for running it dynamically, but that's fine. We do have to perform all these steps. It's not preserved in the memory, so we have to do the calculation and get it into the computer's memory. So then we can see the stability percentage change, and we can see which tickers had which what number of changes over time. Okay, so let me run that, and then we'll have a heat map here. So the heat map is going to show us the probability of clustering transitions. That's what we're getting here. So for cluster 1, 17% chance, or sorry, cluster 0, 17% chance. It's going to be cluster number 4, 0 change from cluster 0 to 3, 0 change from 0 to 2, and 33% change from 1 to 0, and 38% of the time it's the stock starts in cluster 0, which again is just number 1, it's just 0 based, and it just stays there. So most of the time where you start, that's where you end up. And you can see that over here, 61% of the time in the next column, and then 1.0, or it goes from 1 to 0 61% of the time, and 1 to 1 67% of the time. Okay, so that's pretty interesting. Then we have the percentage for each ticker and the stability, overall stability percent of these stock tickers too. So Walmart is at the end here, it's like 80% stable. It doesn't really change, it pretty much stays by itself. Number 2, I guess, would be Cisco. But this Caterpillar and Johnson & Johnson are not very stable. They swing a lot, so those prices move a lot. The same with Merck. Merck, I believe, is a pharmaceutical company, so those are somewhat less stable. Down here we have another interactive chart. I really like these a lot. When you mouse in, you can see the stock ticker. This is Merck, and then where that stock was on a specific date. So then you can see these changes over time, and this key on the right hand side will show you 43210. That's the stock. I'm sorry, that's the cluster number. So we only have a couple of ones. This one's actually 0. This is a 2. But most of these, by and large, are really zeros and ones. So most of the clusters are zeros and ones for most of these stocks. But I like this pattern here, which shows you the date, the change over time. The date is on the x-axis, and then the stock ticker is on the y-axis. As I'm looking at this now, you could probably make this y-axis a little bit longer, so it's easier to interpret. That's okay though. We can zoom in and look at it this way too. But that's probably one thing. If I make a change here, I'll probably make that y-axis a little bit longer. Okay, so now we're moving on to the transitions of stocks from one cluster to another. Okay, we'll get let me run this thing so everything's refreshed here. Okay, we can see the previous cluster and then the current. So that one changed. This one, sorry, that one, first one did not change. The second one did. Third, no change. And then on the next day, there was a change. Okay, so this is all for Apple. So you have the dates, and then it's the ticker, the previous, and the current. Okay, that's useful. Then here's the trading strategy that I developed. Let me run this so everything is refreshed and renewed. Average returns of the strategy negative 0.76%. Okay, so this is actually not a very good strategy here. Stocks are just changing too much, and it's not a good time to be in the market. I ran this a few days ago, and I did have a positive outcome, but we had a couple big drops in the market. Monday, the Dow was down 1,000 points. We had a couple days it was down the prior week 500 points at least each day. So there has been a lot of volatility. Again, this is risky business, guys. If the market is pretty flat, just moving sideways, or if it's bullish and moving up, I think this is a great opportunity. When you have a lot of volatility in the market, like we've seen in the past 2 weeks, and big price dislocations, and all these stock prices moving, sometimes the market's dropping 1,000 points in one day. That's not a good time to be putting your money out there and invest in these kind of things. So that's fine. I ran this like 2 weeks ago, and I did have a positive outcome here, but with so much volatility recently, like all these potential gains are wiped out right now. So this is not a good strategy today. But again, that can change. This can change in a blink of an eye. So in a couple of days now, I can rerun everything and have a positive number. If you get a positive number down here, then it's a good time to put your money in the market. If not, then just stay away from this thing, because it's going to be painful. Okay, so that's about it for today. Again, not investment advice, just explain the mechanics of clustering and price dislocations. Hopefully everybody learned a thing or two here. I think we covered all the bases here. Okay, thanks for your time today. Have a great day.